Welcome everyone, and welcome to the Startup Law 101 here at the DIFC FinTech Hub. My name is Lee McMahon. I'm hoping you can all hear me. Is it working? Good? Perfect. So we've got a lot to go through today, and there's going to be a lot of topics to speak through in relation to your journey from starting up all the way to an exit. So bear with me. This is a high-level overview of the topic. So I'm hoping that the outcome of this session is that you will be able to understand the areas that you probably need to know more about, areas you might want further explanations on. I am here to answer some of your questions by the end of the session. So what we're going to talk about today is we're going to talk about starting. So how should you start? How should you structure? Now, most of you, obviously, the fact that you're already here means that you've probably structured at the very minimum an operating entity or an innovation license. We'll talk about some of the other kind of structures that you're probably going to need to do in order to raise money and grow. We're going to talk about that structuring side. We're going to talk about your raising money, which is obviously a critical part of every startup in their journey. The other one is protecting your business. Okay, it's a critical part, particularly as most startups are ultimately building out IP, and that IP is something that you're looking to protect in order to maintain that value so that you can ultimately exit down the line. Growing your business and exiting your business. So when I speak to every startup, I expect there's a certain amount of documents that I would want to see in your Google Drive, Dropbox, or even your Clara platform. And those things are a co-founders agreement. If you're more than one co-founder, I'd expect a co-founders agreement. Co-founders agreement, which we'll go into more detail in a second, so we'll talk about that. An IP assignment. Now, IP assignment has to come from founders, employees, contractors, developers, and even sometimes your operating entity if you have a new operating company. So we'll talk about that as well. Share incentive plan. Share incentive plan is a critical document. It's something that the timing in which you set that plan up can differ. Some can start it very early on. You might want to give shares very early on in your journey. But can I say to you, by the time you're likely to do a Series A, it's very, very likely that you're going to need to do it then. Early stage investment, a safe agreement, okay, convertible note, that's a key part of your investment rounds. And the other one is a holding company. So if you only have one company at the moment, it's likely you're probably going to have two companies by the time you look to raise any form of equity. So what is covered in a founders agreement? The key thing is in a co-founders agreement, it's often the document that encapsulates a lot of the hard discussions that you would find or you may have spoken about or may have avoided when you were setting up your company. So what are the roles? Fine, that's probably straightforward. You're the CTO, you're the CEO, you're the Chief Marketing Officer, for example. But then there are some of the tougher ones. So what about if you want to leave the company? And this happens quite a lot, particularly with multiple founders. What about if someone doesn't leave, but you want them to leave because they're not performing? What about the ambition? So what's everyone's ambition with a startup? Some might say, I want to do this for 20 years and I want to do an IPO. Others say, if I could exit in 2 or 3 years, I'll do that. So it's very important to understand what everyone's ultimate goal of this is. Time commitment. Now, as we all know, everyone has a different view as to the commitment that you want to put into a startup. Some are very passionate and will work 7 days a week. Others will work and take it like a normal job and finish at 5, 6 o'clock at night. Very important to talk about that. What is your percentage equity split? That's a key thing. Initial contribution, how much money or time is being put in? So is there a combination? The other one is, what are the decisions that you need to make and how are you going to do it? So what happens if one founder says no and another one says yes? How do you deal with that? So these kind of topics are all dealt with in a co-founders agreement. So it's a key document to protect your interests right at the beginning. As a lawyer, I often see a lot of co-founders end up having a lot of fights. And when they have a lot of fights in the early days, the problem is that you don't have a co-founders agreement and you don't talk about what it looks like to exit early and what it looks like to give equity back. You can find yourself in a really dark position where you get stuck and the company will ultimately fail as a result. These documents are in writing. Some people might do it in a very short form term sheet, which is fine. However, it's realistically better to do a fully fledged co-founders agreement. There are a lot of topics, a lot of things you need to talk through. For example, if a co-founder that owns 50% of the company leaves in the first 12 months, they don't walk away with 50%. It's likely they should walk away with 5% at best. This is what we'll call reverse vesting, which is on the percentage. And the key thing is that Co-founders agreement's a bit like a prenuptial agreement. If something's going to go wrong, at least you talk about it before it does, and you talk about what the mechanisms in order to get the exit that idea. So it's interesting that about 80% of startups actually only spend less than an hour negotiating their equity split. Okay, because often when someone's starting up, they're very passionate about it. They know what they're bringing in. Sometimes someone says, "Well, it's my idea, and I brought you in." Therefore, they take more of a majority stake in the business. And they split it, but it's very easy to split equity when ultimately it's just an idea. So investing terms, this is one that actually probably throws a lot of founders out. When you've got your startup, and let's just say there are two of you and you're 50-50, you'll be thinking to yourself, well, why am I investing shares? What's investing? Investing is an ability to earn shares over time, just like a share incentive plan. Or in founder's situation, we call it reverse vesting, which means on your innovation license at DIFC, you will actually see that you've got 50% of shares. So you own 50%, so you think, well, I own this out, take it back. The reality is it's there because companies need to make 100% of shares, so someone has to split it in some way. So the whole concept of reverse vesting that's in co-founders agreements is that if you are going to exit early, the concept is you have not earned all those shares. I see a lot of the time when there is a dispute in these kinds of scenarios that a co-founder says, well, I own 50% and I'm going to own it. The reality is you'll be dead in the water. The startup won't be able to raise money. Investors in the future will say, I'm not going to invest in you, it's going to sort that out. And it will be your problem. It will not be the investor's problem to try and solve it. So again, co-founders agreement allows this mechanism to stay. It might be the first 6 months, 12 months if you leave, you get 0. It might be you get 2.5%. Maybe maybe 5 or 10%. Depends on the output. So it's very important that you might be thinking, well, okay, that's a bit unfair, it's my idea. Well, it might be your idea, but this is why ultimately in a co-founders agreement you spell out all of these mechanisms so you know exactly when you're about to have a potential dispute or something's going to go wrong, you know what the outcome of that's going to be. But can I say to you, vesting, reverse vesting does not just stop here in your early years. When you do a Series A round or an equity round, most investors will want to see that you continue to vest your shares because investment is ultimately in the founders themselves. So what happens is if I'm going to give you $1 million, I'm not giving you $1 million in your company and your idea, I'm giving you guys $1 million to continue to work for 3 more years to build that concept up. And so I want to know that if you did not last 3 years, you're giving shares back because it's my money and it's your time. So that's how the venture capital vesting kind of works. So interestingly, although this is not necessarily purely the case, but startups with multiple founders often will often be more likely to succeed. Now, that's multiple reasons. Some of those reasons can include that if the founder was sick, but also it's a lot to do with decisions because we can all come up with ideas and think that's a great idea. Sometimes you want to be able to speak to another co-founder and find out that you both aligned on that idea. So there are reasons why VCs like it. Confidentiality agreements, also known as non-disclosure agreements, they are obviously quite popular in the startup space. There is a place for them, but I do not want any founder to think that they are a catch-all or that you should send out your NDA to everyone. Unless you've got, essentially, unless you've got a really amazing idea that you're going into dark mode and you only want to talk to people that have signed an NDA, fine. But the best NDAs are just don't give too much information away at any one time, right? So don't just give your Dropbox to someone and say, there you go, this is everything you need to know about us, unless that you have thought through what's the purpose of doing so. One thing with confidentiality agreements is that even if someone was to breach that agreement, the reality is it's a startup. This is very expensive to do a confidentiality agreement. So I want you to be very aware that those documents are helpful. They set a scene in relation to confidentiality, but do not think that somehow magically you're just going to walk to a court and say they breached it. As we all know, ideas are copied all the time. Kareem didn't have an original idea, they copied Uber, right? So ideas, once you're out in the public, they're out in the public. So the key thing here is that unless you're like, for example, you make a product, you know that your product is from a particular part of the world and you know how much that product is being purchased for. So yes, that is confidential and it's engaging. So what can we do? But your idea, where I think a lot of startups get very confused is I'll send out a confidentiality agreement because we're going to tell you about your idea. And trust me, your idea is worth nothing. So don't think that that's going to change you. So we're going to talk about structure for investment now. So as I mentioned earlier, a lot of companies with the DIFC
I don't want to go to the
start with an innovation license, and that's perfectly fine because in DIFC
we have another thing.
it's a comparable jurisdiction. It's enough to be able to raise convertible loan and to
More
raise some
and
money.
more.
It also allows things like multiple class of shares, reverse vesting, which we said we'll talk about in the CoFounders Agreement. However, what will end up happening is when you get closer to your Series A round, so that's an equity round, usually $1 million or more, they'll want to see a holding company that owns your innovation license. And you might think, well, why do I need two companies? Isn't that just more expensive? Well, the reality is that your operating companies will expand as you grow. So you might have a Saudi operating company, you might have a UK operating company, but your holding company is where your intellectual property will sit, it's where your shares will sit. It is going to be where
this is why
your investors, team members, share incentive plans, everything will sit within that holding company. But it's really fancy liability as well. So it might be UGM, DIFC, Cayman, BVI, Singapore, Delaware, UK, who knows? But there's lots of different places a holding company can be. But it's often in a common law jurisdiction, and it's often a tax advantage or remote tax to zero tax jurisdiction. So why are these structures set in place and why have these two entities? Well, the key thing is that you become investable. So you go to a VC, they're going to ask you to get this whole thing set up in order to raise money. So it's critical that you think well ahead of raising money that you set up these structures because it does take time. Clear and enforceable protections. That's not just about the investors, but also the founders. A lot of the things you have in those legal documents will actually be more likely to be easily enforceable. So that's a key thing. There's obviously no foreign ownership restrictions. So if you, for example, you had an onshore company or someone didn't pass security tests or whatever it is, a shareholder. So that's another key thing. And then often holding companies are a lot more cheaper to set up because you're going to be office space. So you're looking at about $2,000 to $3,000 a year in order to have a holding company. So there's a lot of places that can host as your holding company. This list that I have for you is actually based on what a lot of venture capital, a lot of large accelerator programs around the world have provided. So we've got 23 investment jurisdictions. There's probably more. I think the key ones that you should be thinking about is obviously in the UAE, we've got Abu Dhabi Global Markets, DIFC. They're both common law-based jurisdictions, both with holding company structures. Other common ones in this region are Cayman and BVI, so that's another common place. In India and Pakistan and other parts, Singapore is very favorable to double tax treaties. In some parts of the world, like in Egypt, for example, there's a double tax treaty with the Netherlands, so they have a Dutch holdco. And then obviously, in a lot of other parts of the world, there are other countries where the holding company would be, for example, Ireland. That's where HubSpot is, that's where a lot of other kind of companies are, but usually when they've grown much larger. So we're going to talk about raising cash now. So this is an interesting one that 97% of startups raise money on business ideas that are already known. So if I said to you that I'm going to set up the Uber of trucks or the Airbnb of office space, you would know that business model just by mentioning those names. Now, it would have been very difficult with Uber and Airbnb at the time to convince the market this is a kind of a business model that can work. But as a result, that it can work. It's important that when you look to raise money, that you very clearly explain what your business model is, so that VCs can put you in a particular bucket. So it might be that you're a SaaS platform client, or again, you have a particular business model that has been proven to work. So convertible instruments, for a lot of you guys, unless you've already got past the Series A, or unless you're in a particular part of the world, like maybe in the UK, where doing equity a little bit earlier has some tax advantages. Convertible loan, particularly this part of the world, is a critically important way to raise money. Your biggest mistake is raising equity too early. What does that mean? It means selling shares in your company at a valuation. Because once you do that, what often happens with a lot of startups is that they might do it, not do it well, or not do it right, do it with the wrong valuation. not to a shareholders agreement, not to a subscription agreement, not to a disclosure letter. All of these things don't get done. And to do it, even if you set up selling 10% at $300,000, the fact of the matter is the legal documents and the legal effort required to add everyone as a shareholder and to do all those documents, the cost of it outweighs the benefit of the money you're raising. Not to mention the time it's going to take you. So convertible notes are actually, if anything, they should be the only way that you raise up until you get to a Series A. There are two types of main convertible notes: there's convertible loans, and there are safe agreements. So simple access to future equity. There's also a KISS note. KISS note has historically been circulated by 500 startups, so you see them out there. A KISS note can be both a loan or equity, so that's why you'll see them. The main one that I want to talk about is obviously a safe note, because a safe note is ticks a lot of boxes in this region. It's Sharia compliant. Loans, startups, maybe about 4 or 5 years ago, convertible loans were quite popular. They were a lot more popular in the US. That has since converted. Part of the reason is startups do not have debt on their books even prior to conversion. And particularly in this part of the world where you do not have a loan, particularly people signing a convertible loan where it has not been well thought through, or you don't understand the document you're entering into. Because some of those loans can have things like interest, can have things like maturity dates, which means it's forced conversion. And it can also have things where a repayment clause, which is a horrendous thing for a startup to never accept. So what are the key terms in these documents? First one, which is the most important one, is the valuation cap. So as we spoke about earlier, there is no valuation in that convertible loan. So when we talk about a valuation cap, we talk about an amount that ultimately it means the investor will convert at that at the highest possible point in your next round. So I'll give you an example. If I got one, Zuckerberg was in Harvard and I said, I'm going to give you $100,000. If I had not have given him, or he hadn't given me a cap on a convertible note, his next round was $75 million. So my $100,000 converted into $75 million would have been, point something percent of the business. So it would have been a disaster for me taking a risk on his business. Whereas if I'd gone in and said, listen, I'm going to give you $100,000 on a $3 million cap, I would have converted at $3 million, so I would have had X amount of its company. And then as soon as the equity round happened, my shares theoretically would have, times by 8 times, so it would have been a very good investment, or a lot more actually, 25 times. So the other thing, so the valuation cap basically stops a very successful startup going from here to, exponential growth, and where the investors don't get punished by putting money in earlier. But on the flip side is sometimes you'll see startups go out and go, well, I'm doing a convertible at $10 million, and it might be pie in the sky cap. But what happens if you come in and you just only raise money in the next round at $7 million or $6 million? That's what we call a down round. So that's where discounts kick in. So a discount kicks in basically, I get it. We didn't reach what we thought, we didn't reach the cap that I said that we would reach. But as a result, I'm giving you a 15%, 10%, or 20% discount. And that discount is kind of, think of it as like interest, but it adds to the conversion amount once you do a conversion. So if you put $100,000 in, maybe you get $15,000 extra thrown into the mix in order to convert. So it's better than nothing. So that's the discount, that's the downside protection for investors. Repayment is only on to do with loans. I've only seen one in 5 years where that has ever been a good option. Again, I think you have to be a very confident startup founder to feel that your business is going to make a huge amount of money very early on and you can pay back your investors. I've seen it done, but I've seen a lot of people get themselves caught up in a big mess doing that. We've got conversion rights as well. So the conversion rights is that when you do convert, you will always convert at the next highest share. So what that might be is at Series A, it's likely your investors are going to be negotiating preferred shares or rights that give them additional powers above the founders. So often what happens in a convertible loan is you will say something like you will convert at the highest share that is available at the next equity round. So there are some huge benefits in my view of using these documents. Historically, 4 or 5 years ago, using convertible notes in this region was difficult. It was something where you would often come up against investors who wanted to be part of your journey, but they will very much like, I want to buy 10%, how much for 20%? And they will be kind of negotiating like they were buying a slice of a burger restaurant. Whereas here, the key thing is those who are angel investors will know what they're doing, look at these documents, they know the key terms, and it's negotiated very quickly. And the most important thing is you don't have to update your cap table. So your cap table will basically just show option holders or convertible note holders in a particular part, but you don't have to go to the DIFC and add shareholders, get their KYC. So that is done much later, and that is a cost savings. The downside of it is still there are people who are in the space who want to be part of it, particularly maybe large corporates. They don't quite get a say no. There is a potential of material dilution. So, for example, if you go off and someone says, "Well, I'm going to give you $100,000 and a $3 million or a $2 million in cap," you might think, "Well, I need the money, so I'll accept that." The problem you've got is if you don't use a cap table, a convertible note calculator, which, by the way, just Google them, there's heaps of them on the market, they're all free. You play those scenarios out, because what you need to do is you need to say, okay, if I gave $100,000 and a $2 million cap, what would happen if my next round was $7 million? What happens if my next round was $1.5 million? What would happen if I raised $300,000 at a $4 million cap? So these are kind of scenarios will determine your dilution at your next round. It's so critically important that you run about 5 scenarios, which are super low, super high, and everything in between. Because if you don't know that, you will absolutely probably find yourself in a very heavy dilution scenario. So we spoke about the equity finance. It gets converted when you do a valuation. Again, a Series A is usually $1 million or more, but for example, you can be a seed investor that still raised $3 to $4 million at a convertible note before you get to Series A. The cap is a critically important thing. You might be saying, well, how do I determine what the cap is? The question is, it's a negotiation. But the cap is often determined based on your potential growth and also what is going on, where you want to get to in terms of your next round and your dilution. When we talk about expiry or maturity dates, what I would suggest to you on a lot of these documents is that maturity is something you don't want to agree to, because we all don't know when our next round will be. And even if you said that my next round will close in August next year, it won't close in August next year. So don't put yourself under a pressure, because a disgruntled investor might force that provision on you. So it's critically important that you keep yourself quite open on that. The standard safe agreement is quite open, so it's important to use that option. The other thing is to talk about post-money, pre-money. Understand those two terms. We're going to talk about it in a second on the slides. Those two terms are very important, because getting that wrong can also mean that you're going to find yourself in that sort of heavy dilution scenario. So here is what pre-money, post-money, for those of you that haven't kind of delved into what that really means. So what we talk about, when I say I'm raising a pre-money valuation of $1 million, what that means is if I'm raising $250,000 at a pre-money valuation, means I'm currently $1 million, and then I will put $250 above it, which means in total it will be $1.25 million. When we talk about post-money valuation, that's including the raise. So if I said, and I didn't understand the term, which investors saying I'm raising $250,000 at a $1 million post-money valuation, the problem you've got is that, as you can see the difference here, is that really you're valuing yourself at $750, and then you put $250 into $8 million. As you can see, the difference is a 5% dilution just by getting those terms wrong. So really understand the two of those terms and know what it means to have one or the other. And pre-money is obviously a lot easier to determine how your dilution works. So when we do eventually get to an equity financing round, and you are going to go to the stage where you're raising money, remember, an equity financing round is generally when you've already got revenue. Probably your revenues surpass $1 million a year, and you're getting to a stage where you're showing traction, and you're saying this is giving more money in order to grow even more than I currently am. So what's the process? The process will be a term sheet. So you'll get a term sheet. We've got a free term sheet on Clara.co. It's actually one that's all been signed off by the Middle East Venture Capital Association. So that's a free term sheet. Then you get that term sheet. You negotiate with your lead investor or VCs. Then what happens is once that's actually been signed, a lot of people are like, I signed a term sheet, I'm going to get my money any day now. Absolutely wrong. Series rounds take a long time, usually 3 months. So then what will happen is you need the documentation. So that means this drafts shareholders agreement, subscription agreement, disclosure letter. You will need documents which will be part of your condition. So if you haven't signed a co-founders agreement, or maybe you sign one, maybe it's a founder service agreement, which is kind of like an employment agreement, but to the holding company. And you'll need your IP assignment agreement, you'll need your share and setting. So there's all sorts of documents that I'll expect to see in order to be provided. So let's just say you get all those documents, we're all negotiated, we're finished. Then we go into the pre-completion conditions. Now these pre-condition conditions are things like, maybe it might be the holding company, or your operating company, it might be your share and setting plan has to be set up. It might be that your trademark needs to be registered. So understanding all these conditions is really important because if you don't satisfy those conditions, you will not receive $1 of the venture capital money. So then once all that happens, and you've done it to completion, and then sometimes after completion, depending on how you negotiate, you'll have post-completion conditions. Those post-completion conditions might be that you need to register within a trademark within 3 months. It might be that certain things need to happen. It might be that you need to circulate updated cap table, whatever it is. There's all sorts of different things that VCs might want, but often what it is, it's driven around making sure that you are legally structured right, you have all the legal documents that protect the interest of both the investors and founders. And so I want to see all of that in place in order for you to basically get an additional letter that you have not defaulted on your agreement. So we spoke briefly about in an equity round what are the corporate documents I would expect to see at a Series A. So we talked about a term sheet, that's your starting point. That will always be the way you start an equity round. IP assignment agreement, making sure that the IP, the know-how is anything from founders, employees, the developers, the contractors, any particular person who might be contributing to the know-how. Often what happens is people say, I don't do an IP assignment agreement, I don't have a patent, I don't have a trademark. It's not that. It's when there's been some very famous cases, including Snapchat, where when they went to do IPO, one of the early co-founders never really exited the company properly. And his argument was that he owned the IP to the way in which some of the program in Snapchat worked. So they had to pay out hundreds of millions of dollars. And as a result of that pre-IPO, just to get him to sign the IP assignment over. Shareholders agreement, that's the document where the investors and the founders will determine how they're going to manage the company. Subscription agreement, that's the document which says, I will give you $1 million for X amount of preferred shares and on the following terms. So that's the document that needs to be signed there. We'll need board resolutions, shareholders resolutions to confirm the entry into this particular series round. Share incentive plan, okay, like I said earlier, you can do it pretty much straight away, and you can do it now. But if you haven't done it now, 100% of your equity round will need to do it. We're going to talk about share incentive plans in a second. Advisory agreement, for those that have advisors, that document does need to be in place. That'll be something that we'll be looking at. And as I mentioned before, a founders service agreement. This is different to a co-founders agreement. A founders service agreement is often the agreement that is entered into between the founders and the holding company. Basically say we're going to continue to provide services to that holding company, and if you don't, or you, for example, terminated as a result of default, then you would unwind a lot of your shares. Okay, so that's something that investors want to see. So we're really going to talk through what we will see in a term sheet and why it matters. So the core terms of a term sheet, you're going to see obviously what the company is, the type of shares. So you will probably have what we call ordinary shares now, which is just the standard shares in the company. We'll talk about the investment amount, so how much you're raising and how much does that individual investor giving you. We talk about valuation. Remember, this is a value round, so you need a valuation in order to know if post-money or pre-money valuation will be. The dividends, just remember, and one of the biggest things is that startups will never pay a dividend. Startups will never pay a dividend, so the answer will be there were no dividends ever paid. Reserve rights, what they are reserve rights are things to where minority shareholders, often investors, will have a right to say no. Right? They will be also known as blocking rights. So In addition, we have what we call preferred investor rights. Now, these are things called a liquidation preference. What that means is the investor will say, okay, let's say if you would have failed and you had $2 million of assets, it might be code, it might be computers, whatever it is, hardware. They'll say, I want that sold, and we get the first round of that money back into our pockets to reclaim some of our investment amount. And then only when that happens, after that's all been paid back, then we will then split it with the founders, any money left over. So the liquidation preference, if it's ever really triggered, you're dead with the founders won't get any money. But it's fair enough because remember, venture capital is a fund, right? They get other people's money. So that's why they're that. We're talking about conversion rights. Conversion rights is a broad term. We talk about what they're going to be converting that into. So it might be that they're going to convert shares, but it also might be that they want some additional rights, such as we want to pro-rata rights into the next round. So if I own 5% of the company, I'm entitled to get 5% of the company next. And then there's sort of anti-dilution. In some cases, some VCs might negotiate anti-dilution provisions, which might mean that if for whatever reason your next round, so a Series A, a Series B is a down round, maybe a Series A, so you raise $10 million, your next round is $7 million. They might say if it is, they have an opportunity to ensure that they don't get diluted in that future round. Drag along rights. So remember, VCs, once they get to a point where they sort of own 30%, 40% of your capital, they want an ability to be able to drag the founders out if an exit seems like a good deal. Because often what happens is VCs don't want to find themselves in the startup where the founder refuses to let go and thinks that they can make 10 times more the money. If they think that there's a good opportunity on the table, VCs might want to drag those founders on that journey. And again, it's all subject to the wording in the agreements. There are obviously other rights and matters that VCs, every VC might have a specific thing that they might be looking for in those equity rounds. And then board, remember, investors will always want a board seat, and it's really important to have that because as founders, we're passionate about what we're doing in our business, but the investors will come with a very clear understanding of, well, what's the best use of the money, what's the best way to get a return on the cash to inject in the company. And then sometimes in a term sheet, if you get a lead investor, they might want exclusivity for 3 months to negotiate a good deal, and they might go out to their own investors during that process. Because a lot of VCs often act in a consortium style arrangement, but they say, listen, leave it with us before we go out to other people. So we're going to talk briefly now about protecting the business. We're going to talk about your intellectual property and how to protect it. So what is intellectual property? So when a lot of people talk about IP, they probably think maybe it's a trademark, maybe it's a patent. The reality is IP is quite broad. It's often intangible, so it's not something you can see. You don't say, oh, there's my IP sitting on the floor over there. That's not something you can see. It's owned and developed by the company, and it's critically important to understand this because you might have to start with 30 people, and every single day, outside of doing their job, some of them, or all of them, are collectively building know-how that is being commercialized. And that's part of the value that a VC or a future business is going to buy you is looking to purchase. And it has value and it will continue to have value. So what are the different types of IP rights? Well, some of the ones you might know is copyright. It's a copyright on artwork or book. It might be the blog article, it might be the way your website is designed. It might be the way that the wording of your website is, so that's copyright. Now, copyright doesn't have to be registered just by saying it's copyrighted or knowing that you're the author of it is enough in terms of protection. You'll see on the bottom of a website, you would just say copyright and you're the entity in which it's owned. That's just maybe more just to make it very, very clear that the site is specifically owned by someone. Patents, they're more inventions. You don't see as many of them around, particularly over here. I don't see a lot of them. People might all get a patent or an invention on physical goods, but patents are a little bit more expensive. They take a long time to go through the process. It's usually a 12-month or longer process in order to register your patent. We talk about trade secrets. So trade secrets are business information. It's a bit like Apple talking about iPhone 13 or KFC special herbs and spices. They're trade secrets that by releasing that information, you would create losses for their business in terms of their value. And most trade secrets are often heavily protected by confidentiality agreements with very clear rights to be able to litigate in order to recover on those losses. But most startups, a trademark is probably the key thing you're going to do. Now, I always say with trademarks, it is important to register your trademark. It will be a requirement to register your trademark at a Series A. When is the right time to register a trademark? Well, quite frankly, it's at the time when you're starting to spend money on marketing your brand, because what you don't want to do is find yourself in a situation where you both spend hundreds of thousands of dollars on marketing of your brand, and then you find out later on, wait a minute, I didn't do a trademark search, and I realize actually there's a company in Spain, it's the same name, doing something similar, because likely if they've registered a trademark in Europe, you won't be able to continue using that name. So the cost of unwinding your name of your business is a complete utter nightmare. So it's important at the very, very minimum, we don't want to do a trademark search. The other thing is, remember with trademarks is that you could be like, Apple voting, very different to Apple with computers. So there are multiple classes of a particular type of trademark. So just because it's a name that's out there doesn't mean that it's going to be, you're going to get called out. Like for example, for us, we're Clara, and Clara is, there are other companies around the world that have Clara. So, we're Clara in a particular area of SaaS and IT, legal services, and we register. But if you were Clara voting, for example, it's perfectly fine for both of us to have a registered trademark. Can I suggest to you, particularly on trademarks, the best thing to do is go out and register all the domain names, all the social media handles, because what I've noticed over many years working with startups, most names accidentally get taken. It's not something that people go out of their way and try to steal your name. It's usually just because two people have come up with the same name at the same time, and they've both gone off and created their own version of it. So I think it's very important for you to do your homework. In the UAE and Saudi, unfortunately, trademarks are one of the most expensive parts of the world to register. They cost you about $4,200 to fully register your trademark in the UAE, and then you need to register it in Saudi. So there is no GCC-based IP registration, which is quite annoying. You can register in Europe and the US, and that's not that expensive. So if you're going to register here and you think you're going to go global, then I would register in those two markets, and that should cover you off as you grow. So we touched on a little bit before about these IP assignment agreements, these documents which make it very, very clear that the know-how that is being paid to work on is actually owned by the company and not them. The reason why it's important is, I don't know if you know, that in the UAE, for example, under employment agreements, is that only the first 3 inventions and 3 invents is actually owned by the company, otherwise it's owned by the employees. So if you kind of just let it be and think that everyone's going to be trustworthy of that, it's fine, but it's not. Always think when you're a startup, what would I say to myself if I was worth $1 billion? If my company was worth $1 billion and I was in the US, would I have said, I should have got everyone to sign this agreement? It would have been free, it would have been the right thing to do. The answer is you should do it, right? So you're basically doing this for a future science company. So we're talking about employees, contractors, even your operating company. So if you have an innovation license here, and you go off and get an ABJ holding company or a Cayman holding company, we'll actually get the operating entity to sign the IP to the holding company. So all the IP is ultimately owned at that holding company level. Developers are a key one. Even software development agreements, the right is so important because we will often find, as we all know, all technology is usually a sum of parts. So any one part may not be that you own, but how you put it together is something that you want to be able to protect. And so a lot of developers might resell it, as I say, they were doing, maybe you've got the developers in the early days of Blue Guys, and just the same idea, and then reuse that code, and that would not be ideal for you. And the other one, obviously, is critically important as founders, okay? Just in case something happens, one of the founders leaves, you need to make sure all the IP stays with the company and not the founder. It doesn't matter whose idea the business is, right? It's all sustainable company. All of this is a critical part, even if you're doing a safe or convertible note. And particularly in the equity round, you're doing highly due diligence, and I want to see that this is flawlessly tied away. So we talk about growing the business. Now, this is your share incentive plan. So a share incentive plan is something that there are 2 types. There's a share incentive plan and there's a shadow equity plan. I'm going to touch on both of them. But the key thing is in a startup, you need one, right? Because it's very hard to raise money and attract employees at their full salaries that they otherwise wouldn't be working if they work for Microsoft or Google. So you need to be able to give them decisive equity. So it's an ability, it's an ability to buy shares, often at nominal value. So if your shares are worth $1, 1 cent, they're going to get it at that price. It's usually as a way of forming part of your remuneration. So if someone says, I get 20,000 euros a month, you might say, they're going to pay you 12, but 8,000 euros will go towards money towards your share incentive plan. And then an option is granted at a specific price. So here's an example of how a share incentive plan would work. You would have an employee who might get 2.5% of your savings going to be spread over 4 years. Within that 4 years, you have a cliff, and that cliff is like 6 months. And a cliff is think of it as like probation, so it's like you're not going to earn anything for the first 6 months to 12 months. But once you start earning it, then you can earn it. In any case, it can be monthly, it can be yearly, it can be quarterly, it can be there's more at the end, less at the front. So you can try and encourage them to stay until the end of the 4 years. But these are things that are awesome. So the shadow equity are slightly different. Now, they're not as regularly used over here, but they often happen when a company is growing exponentially in the first few years and your staff are in complex or difficult jurisdictions. So I've seen shadow equity plans where a company says, listen, I'm building this. I already know that this particular company in 3 years is going to buy me. I need to put 100 staff on in 3 years. So I cannot afford to put everyone on the cap table and do a proper share incentive plan. So what happens is the founder says, okay, well, today the business is worth $5 million. So I'm going to say, I'm going to allow you to, I'm going to give you shares, and that shares, if we sell at $15 million, I will deduct that $5 million valuation, and that last $10 million will be split in accordance with the shareholding that you have. So it's very much almost like a paper version of a share incentive plan. It's just an optical side, so that the founder, if you sold the company, would get all the money, and then that person will disperse that money to all these people on the family share. So there are some benefits to it. Obviously, cap table, you don't have to worry about all of that. Makes a lot of sense. Tax implications. It's pros and cons. I'll give you an example. If I'm sitting here and I did a phantom share screen, that's fine. Any money I receive is tax-free. But if I went and moved to Norway and all of a sudden I received $1 million and I had to disperse it to everyone else, I would end up having to pay 65 cents on the dollar on the money I received before I dispersed it. So it's kind of something that I would not recommend unless there was a very good reason to do so. The other thing is obviously if something happens to that founder, then your arrangement is with the founder, not with the company. So we talked about that before, how it works. So if you have a particular date, today's valuation, you say, here's the valuation, I'm going to give you X amount of shares, and then ultimately what happens is you net off today's valuation to what ultimately your exit valuation is. And that is what the founder, the employee will get. So, touched on this earlier, want to use one. Firstly, you're going to need one by Series A. But secondly, that, imagine if you are really excited, you're going to be purchased, someone's coming to acquire your business, you get really excited, you come out saying, yes, we're going to be bought tomorrow. Your employees who are not involved in that journey, don't have shares in your company, are not going to enjoy that message. They're going to want to be like, well, what's that mean for me? Do I have a job? So we want everyone to have that ownership mentality. We want them to know that they're excited about the journey, and every good news story about the company is something that they also get to be part of right to the end. So there are some downsides, obviously dilution, but one thing to note with share incentive plans is that that pool share incentive plan, which is often 10% for most startups, is coming out of the founder's share. So don't think I'm going to do a raise, I'm going to have my investors, and then I'm going to find myself in a situation where then after I raise, I will really want to dilute 10%. That won't happen. They'll make you dilute 10% first, and then they will make you, and then they'll do a raise. So just be very, very, it's always coming out of the founder's shares until you've done, until maybe until you're doing a Series B or you're topping up the share incentive plan much later on. For employees, the downside of a share incentive plan is obviously the lack of liquidity, right? You're not going to see cash unless it's an exit. Sometimes at Series B and beyond, we call it secondary, where sometimes investors might say, look, rather than dilute the founders further, why don't we buy out some of the early stage employees, particularly if they are may have left the company already, or you might buy it after the now, so they get some cash on the table. And obviously, the shares are only valuable as the company grows, and they can only be cashed out if the company sells. So when we look at a plan, so there is ultimately how many shares we talk about, maybe 10% is full. What's the exercise price? And this part of the world is generally par value. It can't be called less par value. So you will have noticed your par value is probably 1 cent at the moment. In the US or other tax jurisdictions, par value is can go up in value, basically drown, and that's something different. In the Middle East, you can get away with par value, so the lower per share. You'll also talk about when the shares will vest. So we talk about whether it's monthly, quarterly, yearly, all these kind of things are a critical part of that particular share incentive plan. And how the mechanisms of actually exercising the option. So what happens if an employee reaches year 1, they know they're working on the opposite sheet, what do they need to do? They need to sign an exercise agreement, and that exercise agreement allows them to say, I buy my 1% shares, the founders sign it, or the board signs it, says we confirm it, and then they move from an option holder to a shareholder, and you update your registry of your company. So exiting the business, obviously this is what everyone is probably in the game of being a startup to do. So the different options you've got, you do an asset sale, that's the number one. So sometimes you might find someone and go, look, they really love your business, but I think you've got a great app. I think that if you purchase the app, you could rebrand it and turn it into something else. That happens. Obviously, most people want to set up a full buyout, right? And when they do a full buyout, it's very likely the founders will be locked into that buyout for 2 to 3 years. It's pretty standard. There is a merge. We have seen in the last few years a few startups in the same place merge together. Merge is hard because, as you know, with most founders are kings of their own castle, and so as a result of putting a few people together, it doesn't necessarily well. But if 2 people go in working together, we'll be stronger, we'll be more powerful, we can get more of the market share. Mergers have happened, and I have seen a merge where 2 companies merge and they got exit, and they had an exit 2 years later, so it does work. Acqui-hiring is more, again, where you've got a bunch of founders or a team not as interested, and they know they're passionate, not as interested on the product itself of the company, and they say, listen, we're going to buy out your early stage investors, and we're going to take you guys in for 3 years, and we'll give you a bonus after 3 years. So they essentially buy the team. A joint ventures do happen, particularly in markets like Saudi. If you're moving to Saudi market, you might find that it's a strategic. You say, look, we've got all the infrastructure with you guys in the tech, let's come together and move into this market together. Joint ventures are a little bit harder because there's a lot of things to think about, particularly exits or how you do the budget and whose money it is. So it does get a little bit more complicated. IPO. Now, an IPO in the US is something that every startup will aspire to. In the Middle East, we just aren't there yet. I think this will probably happen in a few more years as we get what we call a secondary market here in the DIFC, which is what happens in other parts of the world where you don't require as big a valuation or as much time in order to IPO. And then the worst case scenario is liquidation. And you'll be surprised that one of the challenges with startups is we obviously want to grow, but sometimes the growth stops and the business fails. And when you do, you need to always remember that 0 in your bank account is not the end. Probably $20,000, $30,000 is the end, because the cost of shutting a company down is expensive. So I think most people think, when I run out of 0 money, then I'll make those decisions. By then, it's often the founders having to put money in just to try and shut the place down because they don't have the liability, their own personal money, often limiting the companies that have, no longer paying lease fees or doing whatever else, or not paying gratuity fees. So I mentioned quite a lot today, so I hope those who stuck with me on this learned something. But I just want to talk about what we're doing here at Clara and how that helps you to achieve all the things I mentioned earlier. So with Clara, we are a platform, we're a law firm, and we're a corporation agent. So we solve a lot of the early stage pain points. In here is all the things that we're trying to map out, talking about CoFounders Agreements and ensuring that the right companies in the right place, and who are your investors, and making sure that everything is there, is all done through the platform. Our cap tables, so the share incentive plan is advanced share incentive plan is built into the platform. So being able to add your employees very easily, sends the documents out by DocuSign, brings it all back into the system. This becomes part of your due diligence when you're looking to raise money. And then there's obviously an ongoing health check. So as a startup, as you know, you'll do what you need to do. You'll set up a company, that's fine. Set up your bank account, that's fine. You might sign a few agreements. The reality is it's usually sitting in a Dropbox. It's not anywhere. You only start really looking at your company when you're looking to do a raise. And it's in that stage when someone says to you, you're missing these 6 things. It's quite late for a piece to fix it, and there's often a cost to fix it. The biggest challenge with startups is they're often in a situation where they wait right to the last minute and they don't have the money to fix it. So this is where the platform allows you to kind of fix these things on an ongoing basis. We also have an academy, that's a key thing. So as a founder, you're actually going to constantly understand these topics and learning about them. And so it's a key thing. You can come in here right now on the Clara website and you can learn about any of the topics I've spoken about today. Any questions, please reach out to me at all, and I'm more than happy to share these slides with you as well. Any questions? I'm here, you can ask, and we can open anything for you.